this panel is really looking at early stage investing from a corporate accelerator point of view. And the panelists have been picked to try and bring out some of the themes that you find if you're a corporate looking at this. So I don't want to do too much speaking here. I'm literally going to get these guys to do the talking, and hopefully later on for you guys to have an opportunity to probe them on what they know and have experienced. Very briefly about my law firm, we're venture capital. I head up a venture capital practice. We're an alternative asset law firm, which we do hedge, private equity, and venture capital, fund formation and investments. We're sort of onshore, offshore. I won't say more, but if you have need for that, let me know. I'm going to go around now and let these guys briefly introduce themselves. So let's start with you, Zack.
Zack Weisfeld, I run Microsoft Ventures Global Accelerator Program. We're active in Bangalore, Beijing, Berlin, London, Paris, Tel Aviv, Seattle, and São Paulo.
Andy, over to you.
That's all?
That's all.
I see. Andy Shannon, I run Startup Bootcamp. We have 10 locations around the world. Our whole model is having between 5 and 10 corporates back each one of our accelerator programs. So they have a very vested interest in our programs, and each one of them has a specific vertical. So for example, in London, we have a fintech program, and we have 12 corporates that all back that same program. So I guess you could say we're specialists in connecting kind of corporates with innovation and startups.
John, please.
Yes. John Mcintyre. I run the Citrix Startup Accelerator. We're based in Silicon Valley, where we've been running a seed funding program for 5 years. Last year, we launched a second program. We call it our Innovators Program. We do it with partners, so other corporations and funds. We do it in different places in the world. So we've done it in different places in the United States, India, and we're expanding into Europe and other places in Asia this year. And we're also including not only startups in this program, but internal corporate innovation teams. So quite unique from that point of view.
And last but not least,
yeah, hello, I'm Peter Cowley. I think I'm the black sheep on this panel, but we'll find out why I say that later on. So I've had a long entrepreneurial career, over 30 years, and then I moved into angel investing about 8 or 9 years ago. Very active, 40 investments, currently Angel of the Year in the UK for another 3 weeks or so. I've also got an academic post at the Judge Management School in Cambridge. I'm on the Angel Co-Fund, which is a £100 million taxpayers-backed investment fund. And the reason, two other connections. One, I run a sort of family office off the corporate balance sheet investment organisation in Cambridge called Martlet. Done about $1 million a year, so small amounts by the standards of this audience, but we've still done about 30 deals there. And secondly, I'm actually an investor in Toby, Tim, and Jim's company, Morsonia, as well, just to make sure that's on the table.
Great. So we've heard a lot today, I guess, generally about corporates and the challenges that they face when they start looking at early stage venturing. In particular, what we're talking about is very early stage. Looking at very early startups and saying, how do you best model that? So we're going to hopefully now start with Zack and ask him, I guess, a difficult question, I think, which is, there's a lot of noise out there. Corporates are, the biggest challenge, I guess, is disrupting the disruptive impact of a new startup, trying to preempt that, trying to spot where that's going to come from. So corporate accelerators, is that the means that we think corporates will do that, and can it be done in this way?
Absolutely. So, well, it depends how you do that. If you run it properly, you can definitely get to that ability to look at the market and see disruption before anyone else. So, as I mentioned, we're in these 8 locations. So we get about 8,000 applications a year. And we only accept 2% of people that apply. If you read through the signals that we see, and you see new business models coming out, and you see new interesting areas of development, and you see new technologies that are jumping out, it's a very unique opportunity for us to see new things happening around in the world. And as quoting my CEO Satya, so Satya said a couple of weeks ago that we were all fixated on a couple of zip codes in the US to see new innovation coming out. And innovation is coming out of India and China and different places around the world these days. So it has served us really well in connecting to the top entrepreneurs globally. We take no equity, so many of them love to come to the program. We provide a lot of services to them. And
I think it's worth saying that's rare, I would say.
It is, but it given us the opportunity to work with so many great entrepreneurs. And so from Microsoft perspective, we've grown the program. It's a young program. It's less than 3-year-old. And how do we know we pick the right companies and we see the right trends? 80% of the people that went through the program got follow-on funding. Average is a bit over $3 million. We had more than 20 exits. So I think we're with the finger on the pulse in many, many places around the world.
I think on average that the process will improve people. I mean, an acceleration that leads to failure before it's got investment is actually a bloody good process. Because if you've got a team that falls apart during the acceleration process, an idea that's never going to stand up in the market, that then can't get funding, that's good news. Because those guys, if they're passionate and driven enough, would go on and do something else. They may not get onto another accelerator. You do hear of, and I'm sure the team know about the panel, people going on multiple accelerators, going on one in London and then somehow getting onto Y Combinator or whatever. So the other question was corporate on the balance sheet. Now, interesting question here, because with my other hats on, with running Martlet, which is an investment fund, which is sort of evergreen coming off a corporate balance sheet, we do occasionally get, and Marshall's just for the background is 104 years old, 4,500 people, 4th generation running it at the moment, 1.4 billion turnover, peanuts in terms of profit, family business, you know, would never stand any good on the stock market. But it's got two things. It's retail cars and it's aerospace. And some of the aerospace is defence. And not everybody wants a defence contractor on their cap table necessarily. The upside is that it's got deep pockets and it's got connections. There's one example where we needed something from the Cummins, which is a diesel engine manufacturer. Could not get that at all. At the bottom end, CEO of Marshall's ring up to the CEO of Cummins, bang, it all happens. So that sort of connection is good. I think the loaded part of the question, though, is if there is let's take an example. I can't think of any, I shouldn't use the panel anyway, but you take somebody who's got a pharmaceutical company, say they've got Merck on the cap table, and you think it might exit to Reckitt and Benckiser. Will that be a problem? You know, will it be a problem that you've already got the corporate in there? And I think the figures are only of the order of 8-9% actually exit to the corporate that's funded in them before. So in general, they exit somewhere else. And the chances are they do exit to one of the other competitive corporates. So I think the jury's still probably out on that. It's not early enough to say that, but I would think there isn't a problem.
Okay. So we're sort of halfway through, and I just wanted to throw open to you guys out there to see if you had any questions that you just immediately want to pick up. There's one there. I don't know if you need a mic. Is there a mic?
Well, we can hear
We'll repeat the question.
Yeah. Okay, my name is Gordon Stewart from Microsoft Ventures. I'm interested if you see any correlation between the age of the startup teams or not.
Okay, so I've done some. I'll just give you my, because I've done some analysis of that.
Do you want me to repeat the question?
Yeah, no, go for it. Actually,
Okay.
I'm just going to say it just in case, right at the back there.
Right. The question was: is there any correlation between the age of the founding team or not?
Okay. So I'm sure there's more information on the panel, but of my 40 or so, the average age, to my amazement, was 39 point something or other. So they're not grads, and I wouldn't invest anyway, grads straight out of college, but they're not grad plus 5 years or anything like that. They've had a corporate life. About 30% have done a startup before, of which not many have been successful, but at least they've gone through that learning process. So in general, though I do hard tech, I don't do B2C apps, which is probably an average age of 12 or something like that. I do, so people who've got engineering background. So in my case, yes, the answer is the ones that are investable in are older, but I'm sure that's different on the panel.
No, it's the same for us because we are B2B and enterprise oriented. Though we have a broader set going into our innovators programs. But a lot of the entrepreneurs have a good amount of experience already in the marketplace, and we like that, of course, because they see a problem that needs to be solved.
So I don't think the question was about the average age. So
Yeah.
I agree about the average age. The success, I would say, we see them, I can't say that I see any correlation so far. We've had amazing teams that we're not sure they would fit the accelerator program. I won't use the number of how old they were. They were older guys, and they were one of the most successful teams we've had in the Tel Aviv program, for example. And we've had really young teams with breakthrough ideas that have been extremely successful. It would be hard for me to say that there is a specific age group that makes, but we do see more and more experienced entrepreneurs getting to the accelerators. Yep. That's for sure. Serial entrepreneurs that feel that model actually adds value, significant value.
I don't have any data on this like Zach as well, but I would say there's probably a sweet spot, and it feels like if the startups are too young, they really don't get that much out of the program because you're meeting so many people and it's just overwhelming. And after 3 months, you just say, "Oh my God, what the hell just happened?" But on the same other side, we've had a lot of 40 or over founders doing really well, but I have seen some personally who they don't want to move to Barcelona for 3 months, or they can't, or they have a family and 3 kids. So some of an accelerator is, we crunch the time, for us at least it's 3 months. You meet 100 mentors, but you don't sleep much. So we really try to especially work with kind of our more mature teams and coach them to how do you actually handle this in the family environment? How do you set your wife and kids up for seeing them once a month for the next 3 months? It is a pretty large stress, so there are some considerations there as well.
To the point that some of the most experienced entrepreneurs got the most out of the program. If we talk about the program specific, because they know what to look for, and they know when it's like a senior executive team taking McKinsey on. It's not because they're not smart enough, because you bring in people with methodology and you can learn faster through working with these people. It's
well, there's I won't plug a client, but there's a group called Entrepreneur First. I know, Peter, you know them as well, and they do literally go to the universities, the technical universities, and grab really sharp guys out of that, rather than getting these guys going to Goldman Sachs, PwCs, etc. They've convinced these folks that being an entrepreneur, joining the program with them, is a really good idea, that actually this is just as viable a project, if you like, and it will see them become much more successful much more quickly. So they've been doing 3 years, they're just closing a fund with us, and they are scaling it up. And their valuation, I think, over the last 3 years of 20 startups worth about 100 million now. So they're closing rounds, and the VCs are interested in what they're propositioning at the moment.
If any in the room are interested in kind of this more internal idea stage, it's probably a good idea to go and check out the Entrepreneur First model. Because at the end of the day, they're taking 40, 50 really smart people without an idea and trying to form businesses. And it seems like a lot of businesses that come to us, at least, they have that same problem, and they say, hey, we've got a bunch of problems here, but we know how to solve them. So maybe there's some kind of overlap with Entrepreneurs First there as well.
There's another group, I saw a study, I can't recall the name of the organization, there's advisory group. They did an analysis on unicorns, and one of the slides was around the age of the founders. And they found most of the unicorns had a founder age matrix of between 35 to 40, I believe. So it was around that age bracket.
A unicorn is a 1 billion valuation, so sort of 100x in UK terms. Yeah.
Andy, what's up with this mentoring thing? Like, what does that even mean? Like, I've never heard that word before really here used, and I don't understand. So at the end of the day, you almost have to have an entire ecosystem development initiative around your program if you're going into an emerging market. Right. Don't expect to have angels lining up and VCs there. I mean, it just doesn't exist, right? So I completely agree with these guys. You have to look at these kind of markets completely different than kind of a developed London or New York or San Francisco.
Yeah, a lot of market development goes into it.
Yeah. Okay. So we have 5 minutes. I'd like to get in at least one more question, if that's possible.
Let's break the record. Let's go for 3 more.
Exactly. Is there someone at the back there? Any more? There you go. Yeah. Just at the front.
By the way, I need to fix a piece of data I from earlier. It's it's not that the valuations that we've gone through are about $1 billion. The total funding is about $1 billion.
Wow.
So, big difference.
Question: if you have companies from the emerging markets, but their ultimate market is, let's say, in a more mature area, how do you advise them on dual headquarters or moving? And not only the Israeli model, what else do you do from your own experience?
Yeah, I guess I can start with that one. Since we're based in Silicon Valley, we're starting to see that happen already. So we ran a program on the East Coast US and in Bangalore, as I mentioned, and we have had teams not necessarily move to the Valley, but spend significant amount of time because we provide them office space and the connections and that type of thing they need. So the old Israeli model, if you want to call it that, is you move the company to Silicon Valley, and that still happens and it'll continue to happen. People will choose to do that if it's the right thing for that company. But what you're going to see, I think, more with emerging markets is they may be able to use their home market as a launch place. They may have much different products than in an emerging market that we would have in a more mature market, but they may be able to go global with it anyway and access capital and other resources that a Silicon Valley can provide. So I think we're going into new models as we go here.
You know, when I came into Startup Bootcamp, I was at Seed Camp at one point as well, and we did kind of U.S. tours to the Valley and that kind of thing. And one of my theories was, man, we should have these hubs around the world. And last year or so, I came to this realization that our startups were having troubles even conquering their home city with their product, no less their home market, right? I don't know, as a UK angel, it feels like, if you get $500,000 to $1 million in funding, probably pre-A, you're still really struggling. That's still a search, and you're not ready to go anywhere outside of your host city. Even going to Paris or Barcelona or whatever for another sales office is really hard. So the companies that I see that really want to go, let's say the US to a bigger market or Southeast Asia, they move literally everybody. Because having a 5-person team and then 1 person in San Francisco and 4 here, you don't have that many resources so early, right? Maybe when you have 5 to 10 million round, then you're starting ready to open these offices. But earlier than that, we at least don't see it being a super value add to have those multiple locations.
But that's part of the work that we do with them. So we have multiple teams that we've helped open up their US, where exactly to open up, how to do that, what's the structure to do that. So we had multiple teams doing that. But we also have, I wouldn't say the other way around, we have teams from other countries that we've saw opportunities in other emerging markets for them. As well as we have investors. We have a group of investors in Brazil that now we've opened up investment opportunities for them in other countries. So we do see a lot of cross-border opportunities, both for the investment community we engage with and the startups. And it really depends, especially as you go later and later stage in these programs. Each startup has a very unique need, and you need to tailor what you do specifically to their need, and it depends which country they need to go and how fast they need to grow.
Do you want to just add one final quick thing?
Yeah, final. So yeah, I've had quite a lot of experience with the Bulgarian. If you take Bulgaria as an emerging market, which you probably shouldn't do, there's a great accelerator there called 11, which is actually funded by EU funding, about 20 million euros of EU funding, and they've got some good output there because there's an awful lot of hard tech in the old Eastern Europe, and they tend to find that the unwashed angels. I've tried to mentor the unwashed angels in Bulgaria, and it's not easy. It really is not easy. They'll invest in property, and that's about it, really, or mines or something like that. But the point about the Bulgarians is that what they're tending to find is that they'll probably keep the tech team back in Bulgaria, but they'll have an office here which is doing the commercial side and finding the funding. It's considerably easier to get funding here, partly because of the tax relief for angels, but partly because the community is so strong and the ecosystem and the support so strong here in London. So they will actually have a dual centre, despite what Zack just said. Yeah.
I haven't asked for the audience, can I?
Sorry?
I have a short ask. For
you
corporate,
literally have 10
so the
seconds.
corporates in the room, there's a tendency now to call BizDev departments accelerators, which is, I find a bit weird. So I don't know, it's a phenomenon that we've seen in many, many places.
We'll take this to the bar later. I think we've got to wrap up. So thank you to the panelists, please. Round of applause.